And why is this such a big deal? You know, on the last episode, I mentioned 40% is a pretty typical premium in M&A. Yes, it is at the small end of town. Rarely do you ever see a 40% premium for a $32 billion takeover. It's pretty spectacular in mining and especially in gold. And yes, the gold price has increased in the month since the initial announcement to market, but it's still pretty substantial.
Right, g'day money miners. Hope you've had a great Easter long weekend. Now Newmont, they've upped their bid for Newcrest. Evolution has updated their guidance due to a gutload of rain in North Queensland. Got Calidus on track to meet guidance, and Panoramic produced 1,500 tonne of nickel at their Savannah project after being also impacted by heavy rain and mill shutdowns. This is Money of Mine for Tuesday, 11th of April. We had Friday, Monday off. Loved it too, won't lie. Hope everyone had a sensational long weekend. JD, Trav, how are we?
G'day, Matty. How are we?
Oh, sensational. JD.
Pumped for week 2.
Pumped for the new. You're a new man, mate. You've now even getting interacted with on social media.
Yeah, do you want to spell it out for us?
Well, both in a positive and negative way. Thanks for everyone's great feedback that we've been getting. We appreciate the good feedback, but equally, we can't show a lack of appreciation for the negative feedback now, and isn't Hot Copper a great forum for that? So, look, we've put ourselves out there. We've posted the YouTube links. Look, had a lot of great comments, but what the way I see it, lads, if you're getting negative feedback, even people that think you're shit are listening to you. So that's a good thing.
That's it.
Now, we won't name and shame, but JD was referred to as the old bespectacled fella. I assume they were talking about JD.
Mate, you are the youngest person here by a country mile.
One fella on Hot Copper, this was like medium intensity, gave this a run. Don't mind the Aussie larrikin how you going feel to it, to be honest. So they make the same fist of this financial media bullshit as Koshy or anyone else does. So that wasn't too bad. Then we go on to the next one. I like this one. Lasted 2 minutes. Couldn't stand the excruciating bogan accent of the host. I think they were talking about me. Sorry, big fella, won't be changing that one. And look,
yeah, just on that one, Matty, I find it bizarre that Jonas, who is from the most remote place of all of us, and we're all from country towns, but he sounds by far the most intelligent.
You've got Leonora Kalgoorlie and, I would have thought I'm definitely probably the least remote. Now, final one. I was going to say that this podcast was the least insightful I've ever come across. I'm not disputing what they had to say, but they said very little, and I want my 5 minutes back. Good luck to you if you're looking to them for investment advice. Now, if you go to lifeofminepodcast.com, haters, there is a voicemail function there. You can actually leave a voicemail. So if you'd like to take your abuse to the next level, leave a voicemail and we'll happily play it on the show. So, bring on the hate. I love it. I don't know how you boys might have been a bit confronted at the start, but it really gets me going. The
Hot Copper crowd is pretty fascinating, and they, if you don't pump up their bags, they're not very happy with you. And I think it's a good opportunity for us to sort of actually relay what the sort of content we are trying to put out there. It's not going to be super promotional stuff. There might be the occasion where we give credit to a company where it's due, but most of the time we're an ex-miner, an ex-banker, and an ex-equity research guy that are coming together and providing our insight to the extent that we have it on the market as we see it.
Yeah, and for the record, my girlfriend said the glasses were quite good. So what else can you do?
Oh, well, look, and we'll do a little segment like that each day. Why not? Add a bit of humour to the day. So, right, let's get on to it. Newcrest, Newmont. So, Newmont have upped their bid. Unsurprisingly, they've gone for a bigger offer, 0.4 Newmont shares per Newcrest share, valuing it a bit over $32 at today's Newmont share price. Let's get into it, lads. What's going on?
Well, mate, this is obviously a giant deal. It's the biggest deal.
Bloody huge.
It's the biggest deal, in Australia for the year. It's the biggest deal in mining for the year. It's massive by every stretch of the imagination. And there's going to be that much content out there about this deal that I'm not going to dive into rationale and what it means from that sort of perspective. I think the insight that I think I can add here is actually just talking about the M&A strategy that's been taken on here, primarily by the board of Newcrest in order to get this result. So this deal now, as it appears, Newcrest shareholders, they're going to be getting 0.4 Newmont shares per Newcrest share, plus the Newcrest shareholders, they're also going to receive a special franked dividend of US $1.10 just to flush out its franking credits. And
so that's once they do this deal, because they won't be trading on the AISX anymore, those franking credits would be still there. They need to get rid of them because they've paid the tax already. Is that what that means?
I actually think that they will probably still trade on the ASX. It'll just be the case that the CDIs of Newmont will trade on the ASX, kind of similar to what you saw when Block took over Afterpay last year. So it probably will, but the franking credits are effectively just a function of the Australian tax regime that we have here, and it only really benefits Australian domiciled shareholders. So back to the M&A strategy that's happened here. I'll just do a little quick recap of what the announcements sort of were to the market and what we could see from the outside looking in on this deal. The first proposal came from Newmont, and it was knocked back by the Newcrest board behind closed doors. This all happened privately before it was ever announced to the market, and that was at an exchange ratio of 0.363 Newmont shares per Newcrest share. And the second proposal came in at 0.38, so that's a bit of a kicker already. And this one was knocked back. However, it was actually leaked before it was knocked back. So it was leaked to the market, and then essentially Newcrest had to come out and say that they're considering this proposal, and they were confirming the media speculation, but they were considering the proposal. And it took them 10 days before they actually provided what their indication was going to be on this proposal. And when they finally did that on the 16th of February, it was pretty interesting language and a pretty interesting strategy that you could see some real thinking into what the board there was trying to do. On that announcement on the 16th of February, they said that the value still wasn't there at that price effectively, but their plan was to open the door slightly, and they actually gave Newcrest some non-public information on a non-exclusive basis, was their wording. And what that means in banking jargon is essentially the board believed that they weren't getting full value or appropriate value for the company at that exchange ratio. And in an effort to get value to where they believed it actually was, they've provided Newmont with what I think is probably just a brief investor pack. But the main thing, if you're trying to persuade someone on value, is giving them a financial model. And this financial model, it will ultimately just be a culmination of all of the assets, and that'll spit itself out into an NPV or a NAV per share. And that number is used as the basis to argue your value. So this model is typically just the corporate model, and bankers will add a little bit of overlay to that to sort of make it look a bit nicer, and sometimes juice some assumptions to paint it in the highest color. And the other piece of information there was that it was on a non-exclusive basis. So it wouldn't be surprising to me if what Newcrest strategy here was to actually share that information with other potential bidders in order to try and create a little bit of competitive tension. So you could think of other potential acquirers such as a Barrick or an Agnico being shared this information as well, just to test the market to see if they could actually create a bit of competitive tension and get the best potential outcome for shareholders. Now, of course, we don't know what those conversations were or what they might have been. It's sort of none of that's been disclosed. However, if you look at what's happened now, you can basically infer that this strategy has worked remarkably well for them, because in this later offer, it's a 16% kicker on the last one. And in total, it actually represents a 41.2% premium to Newcrest's undisturbed 30-day volume-weighted average price. And why is this such a big deal? You know, on the last episode, I mentioned 40% is a pretty typical premium in M&A. Yes, it is at the small end of town. Rarely do you ever see a 40% premium for a $32 billion takeover. It's pretty spectacular in mining, and especially in gold. And yes, the gold price has increased in the month since the initial announcement to market, but it's still pretty substantial. Cast your mind back to the Northern Star Saracen deal, and it was a fraction of the size. But that was effectively a very low premium merger of equals. There was just a special dividend for Saracen shareholders, and they got it over the line. So, Newcrest, they've now agreed to fully open the door. What does that mean? They've granted exclusive due diligence to Newmont, and it's going to be a bilateral due diligence process that happens over 4 weeks. Both parties have access to the data room of each other, and they're just confirming that value makes sense with all this other information. And it looks like this deal will probably go ahead with no more spanners in the works.
Yeah, I think what you highlighted at the end there, Trav, access to the data room, that's a term we see thrown around lots in financial media and mining media. And what that's essentially doing at this stage is giving Newmont access to all the information, be it valuation, geological and everything that Newcrest has accumulated on its asset, which will give Newmont a more sturdy foundation to value all those assets and ensure that they're paying the right price for this company.
Right. 2 things I want to ask you before we move on. Do you see this as a good deal long term, considering Newcrest was trading up near $40 back in 2019? Have they effectively, even though with a 40% premium, do you think they've got them pretty cheap?
The one piece of information I can add there is Newmont have opportunistically made this bid because it looks like Newcrest is a bit beaten up. They're not. Everyone is scared of paying too much for a company, especially when you're talking these sort of quantums. So, Newmont might have for a long time thought there's a rationale to put the 2 companies together, but they're not going to make a takeover offer back when they're at their all-time high. They know they're going to probably have to pay a premium of some description. I imagine at the beginning they didn't think a 40% premium was what it was going to take, but they're happy to pay it seems, when they've been persuaded on value. So, look, I think ultimately, given where Newcrest's share price was trading earlier this year, this is a fantastic outcome for Newcrest shareholders. However, I can't comment on what might have led to the company sort of share price dwindling in the way it has since 2019.
Now, second thing, Lihir, which is Newcrest, I think it is their biggest producing asset, Lihir in PNG, considering what has just transpired with Porgera that we covered last week, PNG taking over 50% ownership of that asset. There was reports previously that Newmont CEO was going to divest Lihir, but article in the AFR, the comments alluded to the fact that they wanted to keep Lihir once Newmont take them over. Do you see Lihir, PNG, a bit of a risk for this takeover deal?
Look, Matty, it's a different risk profile, absolutely, and you're the resident PNG expert on the podcast. So I'm trusting your insight as to how things unfold there.
Well, Wafi-Golpu is another interesting one, in addition, because they signed the MOU the other day. So Newcrest have a 50-50 joint venture with Harmony Gold for Wafi-Golpu. So that's the copper gold project in PNG as well. So, and that it's primarily a copper. I think it's the value is about 2.5 times for copper as what it is to gold of what they're going to pump out a year. So there is that, but that's a pretty small producer compared to Lihir. So it's definitely a lot going on in that PNG space. Newcrest are exposed to it with Wafi-Golpu and Lihir. So it'll definitely be something to keep our eyes on going forward once this takeover goes through. So, yeah, it'd be interesting. I'll taken a bit of an interest in the PNG since we've started this podcast. So they're good supporters of rugby league too. So now on to Evolution. EVN updated their guidance. Weather impact, North Queensland, been absolutely gutload of rain over there. Ernest Henry's been impacted by it up near Cloncurry. March quarter performance. JD, what's happening, mate?
Yeah, that's it. So
the weatherman.
They've come out with a few highlights. I'll touch on the March quarter performance for the company as a whole quickly. 164,000 ounces, 9.6 thousand tonnes of copper produced at an all-in sustaining cost in Aussie dollar terms of $1,290. So as you touched on, their Ernest Henry asset near Cloncurry in Queensland had a fair bit of bad weather about a month ago now. So 29Metals was another company we saw suffer pretty badly from the downpour they had for about a week over there. And what Evolution did was they ended up bringing forward planned maintenance that they'd had. They flagged that they'd shut down the operations for 6 weeks and then they'd come back to the market. So what they've now done is they've updated guidance, the key numbers there being 660,000 ounces, 48,000 tonnes of copper at an all-in sustaining cost of $1,390. So quite a significant increase in the all-in sustaining cost there. So for Ernest Henry specifically, it means about 17,000 ounces of gold less is produced for FY23. And in terms of copper, about 10,000 tonnes will be 10,000 tonnes less will be produced over the financial year. And they've also mentioned that they will stick to this 6-week timeframe, and they'll be up and producing again. We'd see probably in about a fortnight or so. So there was a statement. It was only a 2-page announcement that the company came out with, but a statement that really stood out to me. And for people listening to the podcast, I'll just read it out. Group all-in sustaining cost has been impacted by the temporary lower copper production, which equates to an increase of $195 per ounce and is the main contributor to the change guidance. This being partially mitigated by the higher copper price and the forecast lower sustaining capital for the year. So for those that are unfamiliar, we're going to just quickly go through how companies treat byproduct credits. So at an asset like Ernest Henry, the main commodity that they're producing is gold, and they're also selling quite a bit of copper. Now, what that means is a company like Evolution will, rather than add the revenue they receive from the copper, they'll subtract it from the costs of mining the gold. So that
this is for the purpose of reporting your all-in sustaining cost. Is that right?
Yeah, that's exactly right, Trav. So we'll pull up for people watching on the YouTube a chart which puts Ernest Henry and all other major gold mines in Australia sort of into perspective. So what you have on the y-axis is all the companies ranked by their all-in sustaining cost, and then just a list of the producers. And you'll see Cadia and Ernest Henry at just hugely lower all-in sustaining costs. Now, this is, as I just mentioned there, a direct result of those two assets producing a large amount of byproduct credits, in both these cases, a large amount of copper. So
it's pretty bizarre when you look at that. I mean, you literally see a negative all-in sustaining cost reported.
Yeah,
which unless
you're aware anything.
Unless you're aware of the fact that it's a byproduct credit, you just think, how can you produce gold at a negative cost?
Absolutely, and it's a huge gripe that I think a lot of analysts have with the mining space as a whole. It's one of the key reasons Evolution stands out in a lot of comparables and charts that people put together, and it's the key reason why they can bill themselves as a standout, low-cost, high-margin producer because of this gold and because of the copper that they produce. And Ernest Henry produces, amongst their 5 assets, a huge amount of copper, which can be then deducted from the group all-in sustaining cost.
Is there a better way to present this? What is the comparison? If you're going to try and compare a copper gold miner versus a gold miner, for instance, would you have to go down the road of just sheerly looking at profit margins?
I think, Matty, you hit the nail on the head there. Like, we should really just be laser focused on operating free cash flow.
Yeah.
So they're trying to market. They're using it as a marketing tool, essentially.
Yeah, they, in a sense, try and make it easier for analysts, but it's not really an apples to apples comparison when this thing receives 2 revenue streams and the cost outlook is quite different.
Yeah. Now, for everyone's info about what rain does to underground mining operations, when they say impacted by heavy rain, it's not the fact that you can't get there and there's mud everywhere. You think of any underground mine as just a big giant funnel. So between the portal accesses, the ventilation shaft accesses, all the rain just reports to those area and it goes downhill, and you will lose access to the bottom of the mine. It just fills up like a bottle of water. So I would anticipate, well, I do know that this is what happened at Ernest Henry. So you end up losing, and then you lose infrastructure, you lose electrical boxes because you literally can't get them out in time as quicker than the water's rising. So that is what heavy impact does to underground mining. So you can see operating in tropical areas like North Queensland, up in like places near Broome, and like even in the Pilbara, like heavy rain in wet seasons has a big impact on compared to operating places like Kalgoorlie. So it's always a risk to identify. On to Calidus, Trav. Calidus. On track to meet guidance with record 16,000 ounces of gold sold. Been heavily talked about, and Calidus reflects our new logo. We're going to tie this in. The Lassonde Curve.
Mate, no spoilers. Come on.
Oh, should have I spoiled it? I've got that. That's the hook.
That's the hook.
That's the YouTube hook.
That's the hook.
Take it away, brother.
Matty, it's a pretty similar style of announcement in my perspective to the Red 5 one that we saw literally last week, and we gave a big talk about what sort of transpired in the lead up to their production. Calidus has undergone not the same, but not a completely different journey themselves in terms of getting finance. Their financing process actually happened a lot faster. However, they've similarly experienced a few hiccups in the ramp up process, and I'll break this down by actually discussing that Lassonde curve. This is for the YouTube listener. I'm going to bring it up on screen, and what we see here, thanks to Visual Capitalist, is a very visual chart that explains the value of a mineral deposit over its life cycle. And when you learn Mining Finance 101, this is the very first thing you learn, is how is a mineral deposit learned over the life cycle, from all the way from its concept to its sort of depletion and rehabilitation over time. And what we see on this chart is at the very beginning, these geologists will have some concept, they'll prove it up, they might even sort of put some drill holes in and test it, and there's some structural indication that there could be mineralization there, and then it can become a company, and the company can raise some money and get publicly listed, and they can drill a bunch of holes, and every now and again, one of those exploration companies actually finds something that's worth mining. And when that happens, that discovery happens, there's a lot of speculative interest in the stock, and you typically see the value of the company shoot right up. The speculation is enormous, and there's so much potential because you don't know how big it is yet. So quite often the stock price sort of runs away, and then what happens is, as more drill results come out, the investor community becomes more informed about the real parameters of the size and economics of what this deposit might be. And as that becomes more closed off and defined over time, then that euphoria sort of leaves the market, and the company is progressing towards mining. So they're doing the scoping study and the feasibility study, as Jonas talked about on Friday's episode. And as soon as the company starts talking about their studies, as soon as they mention the word CapEx, you typically find the investors get scared because they think, oh no, the company's got to raise money and I get diluted in an enormous amount. And that period there is called the trough of disillusionment. And you see on our picture from the Visual Capitalist that trough typically coincides with the studies and also the construction period, because it can take a long time and there's no new exciting news. There's no new big deposit. It's hard to really get excited about a company building a mine. And there's actually, in that process, there's a transition of the company becomes increasingly institutionalized from a shareholder perspective. The institutions come on board and the retail market typically leave because it's not as juicy and as exciting. So all in this process, in theory, if a company executes well, it's becoming de-risked over time, even though when they're building it. And so they're de-risking the whole process, and they're getting closer to positive cash flow. And so what you typically see is that re-rating that happens, and you can see that by the bump up in the life cycle curve. When that re-rating is supposed to happen, in theory, it sort of maxes out right as the company starts producing, and all of a sudden you can see that this is going to be a really great mine, and then the value of the mineral deposit declines over time as depletion happens. But if you're a shareholder, you're getting those returns in the form of dividends, or the company's reinvesting that capital efficiently. So that's kind of the gist of mining finance, all the way from concept through to depletion and rehabilitation. Now, why is this relevant to Calidus, you might ask? Well, I'm just going to bring up a bit of a share price of Calidus, and I've just marked on top of it just some key dates for the listeners and watchers out there. So kudos to Google for this share price chart. There is a bit of chart crime going on because the y-axis only goes down to 0.2, so things aren't as dire as they might seem visually. However, I've kept the Lassonde curve in the top right corner there, and you can kind of see that we almost get it. It's very, very, very similar to the Calidus share price. Calidus, they put out their DFS in September 2020, and they called themselves fully funded in December that year. But they funded it with 80% debt, and that's a pretty big number. And And then they went through that trough of disillusionment, as you can see, and they started mining in December 2021. The first ore they began processing in April 2022, and all this time the share price is going up, largely because of that de-risking. So the market is under the impression that they're de-risking things are getting better, share price is going up, and instead of keep going up all the way until they start mining, then it starts to trend down, and that's because we get a bit of a sniff that things aren't quite going smoothly. In August 2022, Calidus raised $20 million of new equity, and the use of funds that they purported to market was to fund their growth projects. But by the September quarterly, the market got a sniff that ramp up of the Warrawoona project was not going as smoothly as had hoped, and the company actually mentioned that there was grade control reconciliation issues. The mill head grade was 0.78 grams per tonne versus the diluted grade control model prediction of 1.01 grams per tonne. And in a low grade operation, that causes enough alarm in the market to get worried. So, and I think that partially explains why you see that drop off in share price that's happened since. The company though did announce commercial production in January of this year, which in theory means that they're making money on the asset. And this announcement today is that they're on track to meet their guidance, and that's a positive announcement. But however, I'm still not overly optimistic about the outlook of the company, and by the looks of it, neither is the market, based on the way the share price is trading. And that's because there's a few things you need to keep in mind, that even if they're making money on the asset, this company is going to be stretched just to service their debt. So they've got $102 million of outstanding debt at the moment, and on the last quarter alone, they had to spend $7.4 million to service that debt. $2.4 million of that was interest alone, and then on top of that large debt quantum, they've got 127,000 ounces hedged at the moment at a forward price of $2,400 per ounce Aussie.
Oh, that sucks.
When the current gold price is Aussie 3,000 per ounce, you're constrained to ever really make decent margin on the gold that you're selling. So when you look at Calidus's cash position, they finished the December quarter with $12.4 million in cash and bullion. And that doesn't leave them with much breathing room when you have $102 million of debt to repay your your hedge book is so far out of the money that you can't make decent margin, and you've already had some issues on ramp up. And I think that's why we're seeing the share price doing what it's doing right now, rather than going up all the way until you're producing like the Lassonde Curve happens, and then declining with depletion. So just to circle all the way back on this beautiful Lassonde Curve, the astute money miner out there might have noticed that we've had a bit of a marketing refresh over the weekend, and you might be able to pick out what we've chosen for our new logo, Matty. It is in fact the Lassonde Curve.
Have a look at that. It's at that inflection point. You say that's I guess the end of our logo is that point. Is like, is it going or is it not? As you see, Calidus kept going beyond that point.
Yeah, I think that was really well put, Trav. And there's a few things I just want to add to that. Firstly, with regards to hedging, that's often not something that the company has an awful lot of say in. Like you mentioned in Calidus's case, they had a debt to equity ratio of 80-20, which you'd often imply from that the people that have provided the debt would want to put a few assurities around that, and they would make the company hedge some of its forward or future gold production. And just to really emphasize this point and put it into perspective across the market, there's a few other companies that we follow that we've spoken about over the last week that are going through this exact experience. So Galena is one that comes to mind. They've just gone into a trading halt. They're coming out as they've just finished constructing the processing plant. Mincor were in that ramp-up phase. Panoramic is another name we'll speak about soon, who are also in that ramp-up phase. And it really highlights that there's different stages on the Lassonde Curve, which are attractive and come with different risks to different investors. So that initial phase is really exciting. A lot of retail speculators will be in there. That secondary sort of uptick that we see is where a lot of institutions will come in and try and determine that this is a risk they're comfortable with, or it's a management team that they believe can mitigate all the risks and get the company from being a developer to being a producer.
With the hedging, say you've hedged 120,000 ounces like these guys have, can you sell half hedge, half spot, or do you have to sell all your hedge first? How does that all work?
They're typically structured. I mean, correct. They're not fully hedged, Calidus, by any stretch of the imagination. They are still exposed to spot because they've spread that hedging obligation out over several years.
Yeah, companies will have various strategies. WAF comes to mind as a company that doesn't like to hedge, but other companies will have strategies such as hedging 1/3 of production for each of the next 3 years, as an example.
And that's there's obviously the risk side, but do you say it's heavily dependent on debt as well? Debt can be, you will be required to hedge
debt,
to fulfill
and once
debt
the debt's
obligations.
paid down, just a decision by management.
Yeah. Very good, lads. Good work, Trav. Great release of the logo, and tied into some great mining news at the time. We'll get on to Panoramic Resources, PANJD. March quarter production results up at Savannah. So that's up north. I think it's near Bruce. Fitzroy Crossing, I think.
Up near the old Argyle Diamond Mine up in the Kimberley.
Yeah. Haven't had the pleasure of taking the long flight up there to that heat. 174,000 tonne mine, 81% recovered, and 1,500 tonne of nickel. They're in the ramp up, JD.
Yep, so we will actually touch on that weather again later. We'll just skim a few more of the highlights. 174,000 tonnes mined, recoveries 81%. Like you said, 1,500 tonnes of nickel produced, 820 tonnes of copper, and about 100 tonnes of cobalt, all in concentrate. So this is a company that's still, like I said before, on the way to full nameplate capacity. So once they reach that'll be 960,000 tonnes per annum, and we're expecting them to get there by the start of FY24. So once the company's up and running, we're going to expect nickel production to be between 9,000 and 10,000 tonnes, and copper around the 6,000 tonne mark. So what the company's come out with isn't a full quarterly, it's just highlighting some of the key numbers, and we'll go into them a bit. Costs weren't provided in any detail, but the company had come out a few weeks ago with a new revised life of mine plan, and this highlighted $8.57 per pound all-in cost. The company did state in this announcement that they have $32 million in cash, so doing a bit of work from the previous quarterly, that would put their debt position at about $60 million, and noting that they've got a roughly $22 million debt repayment due at the end of this year. So something the company had previously flagged is that they'd want to extend that revolving debt facility with a commodity trader. So we'll keep an eye out, and that would sort of give investors a bit more assurity about the cash on hand that they have. Now, going into the weather, what we'd previously touched on, the company had mentioned severe weather disruption. So this isn't an unusual thing up in the Kimberley. They get a lot of rain from sort of November-ish to about March. And what sort of happens up there is that the rivers will completely flood, and no trucks or any form of logistics or anything will be able to get in, and the Savannah mine will be cut off from both sides. And what they've flagged is that parts and labour both were not able to get to the mine. So what this in turn does to the operation is that they'd had a planned maintenance for the mill, and this ends up getting extended, and the company then can no longer produce the paste which is needed, which we'll get to you in a second on, which comes from the mill and the tailings that are produced. So one of the lines that stood out to me was that jumbo development was down 30% to 803 metres. And as you're our undergrounding mining resident chief, we'll go over to you to just flesh out what that sort of means, what development means basically, and what the company's talking about here with the extended maintenance down period and how that impacts production going forward.
Yeah, so I guess development and production, jumbo development, they're separate in a way but can be tied together. So if you start with the actual jumbo development, that's the development, the accesses, the tunnels to get to the ore body to pave the way for the bulk production, which is the bulk extraction of the ore. So your waste, like your decline development, that's your travel way to get down there. So if your jumbo development is 30% below, so anticipating that they were chasing about 1,000 metres close to, and they've only got 800, that means so down 1,100. Geez, the maths is getting a bit rough now. I've left the engineering scene. So everything sort of gets delayed. So your decline development means you're accessing levels later on. You might be your ore drive development might be, if that's reduced, then your stopes are then pushed out. So the whole schedule sort of pushes forward. It's like when we talked about the slashing, how it just delays everything. So it does have a flow-on effect. It mightn't be in this quarter, but it might be in a year's time that they mightn't get to an ore body as quick. So that's where the jumbo development comes in. But when you have the mill shut down, so this is a paste fill mine, it appears, I haven't been there, but it is paste fill. So that means that they extract every single bit of ore and they fill the stopes. So the 20 by 20 by 50 metres high, for instance, they fill that big chunk with paste. And then that paste is a big chunk of cement, essentially, and then they can mine the rock adjacent to that cement and get full extraction of the ore. That paste is made up of like a cement mixed with mill tailings. So all the mill tailings are when they process the nickel, it's all the shit that comes out the back end. That's called tailings. So instead of sending most of it to the tailings dam, they'll mix cement with it, pump it back underground and fill the voids that are created from the stopes. If you shut down the mill, you don't produce tailings, which means you don't produce paste. So if you've got a planned mill shutdown, this will be taken into account in the schedule. But if that mill shutdown then is overrun due to, which appears what happens here, so the subsequent stopes are then all pushed out in the schedule because you haven't been able to fill the predecessor stope, which then delays the access to the subsequent stope, and then that just flows on from there because it is a sequence-driven schedule. You can't mine number two without mining number one. You can't just skip it because you start losing ore. So it does have a big impact. And as I said, some mines have supplementary fill. So Gwalia, for instance, this is what it used to be like. I'm not sure if it still is. They could use old mill tailings and mix it with tailings and cement, and they could just pump as much paste in there as they want. Whereas mines like this, and it's something to consider with mines like greenfield mines like DeGrussa was like this. I would think Liontown will be like this. There is always a very hard balance between backfill and mining because you need to be mining the ore to generate the paste to fill the thing. So if you have shutdowns and you get behind, you have to start chucking extra fill in. So DeGrussa, for instance, they had to put extra cemented rock fill in, so mix waste with cement to actually make up that gap that the paste fell behind in.
And I think it really...
Something to consider.
Yeah, I think it really highlights that when a mine does fall behind on production and looks like it won't meet guidance, it is awfully hard to catch that production. Well,
the backfill's the biggest one because you can't catch up fill when you're in that balance with paste. It's a tough one to get your head around, but you just can't catch it up. You have to get extra fill created to actually do it. So it's definitely a risk for paste fill operations.
Perfect, Matty. Great.
Oh, hey, God, happy to help, lads. Happy to help. No dramas at all. Right, recap on all the other news that's out there that didn't make the top four. We've got Breaker. BRB have come out with their target statement recommending shareholders to hit the accept button for their takeover offer by Ramelius. And Tom, the Colonel Sanders, still intends to remove the Breaker board post-takeover. We covered last week the Arafura went into a trading halt, so they've signed an NDPR offtake agreement with global wind turbine manufacturer Siemens Gamesa. Pronounced it wrong probably. They're a renewable energy company, wind turbine manufacturer in Germany, so that satisfies the German offtake for the loan that they got as well. So that was one. It was conditional on that. Labyrinth Resource release a 95,000 ounce mineral resource estimate for their Comet Vale operation near Menzies. They were trading up 36% early in the day today. Ding, ding, ding. I have an interest in that one. Nova Minerals increases its mineral resource estimate to 9.9 million ounces with a phase 2 scoping study underway. The stock is down 20% on this news. Gentlemen, thank you very much.
Thanks, Matty.
Thanks, guys.
Great research. Trav, loved the graph. Loved the graph with the annotations. Really took that to a new level.
Every time a money miner sees our beautiful logo on their podcast or YouTube app, they'll think of that Lassonde Curve now.
Yes, exactly. And look, hot copper people out there, whether you love us or hate us, comment. And if you do hate us, we'd love to hear it because we thrive on it. Stay. What's the anchor man? Stay classy, money miners. That's the one. Hooroo, everyone. Cheers.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation, or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation, and needs.